Hello, I'm Darryl Montgomery, organizer of the New York Investing Meetup. The following is part of a presentation given at one of our recent meetings. It's one of 5 videos in the series. Now, let's hear Bob Rubin discuss how to profit from the falling dollar.
Commodities. Remember, we were saying before that commodities generally are a good thing because there's some inherent value in the commodity. People are using it for some industrial process. So if a currency like the dollar weakens, then it takes more dollars to buy 1 unit of the commodity. So as the dollar trends down, commodities generally are going to trend up. And again, these are very easy to buy. There's a lot of ETFs that are focused on commodities, and I've got lists here of some of the different types. You have broad-based commodity ETFs that hold lots of different commodities. There's a bunch that specialize in oil or gas, some that specialize in gold or silver. There's one here specializes in precious metals generally. That includes gold, silver, palladium, platinum, etc. One that looks at base metals, which you shouldn't ignore either. Things like tin and lead and zinc are important for a lot of industrial processes. And the agricultural ETFs as well. People tend to think of commodities in terms of minerals, but foods are also commodities, and there's options on most of these as well if you want to trade more aggressively. A strategy that some people use is to buy stocks in commodity-producing countries. Australia, Norway, Canada, etc. However, analysts have shown that there's only a modest correlation between those prices and commodity prices. You can buy companies that produce commodities, and I just very quickly mentioned some of the types here. A junior company is one that goes exploring. For instance, in the gold business, a junior gold company is typically a small company that goes around the world looking for gold deposits. And generally, when they find it, they will sell their interest to a senior company, and the senior companies are the ones that actually produce the commodities. And you need to be aware there of the distinction between hedged and non-hedged producers. There are some companies that let their prices fluctuate with the price of the commodity. There are others that deliberately try to stabilize their prices to make their stocks less speculative for conservative investors. So if you're going to invest in any of those companies, you need to understand what type of company you're buying. Is it one that's going to directly reflect commodity price movements, or one that has been deliberately hedged to avoid that? And this actually is a very hot area for investment. Why companies providing commodity infrastructure as opposed to the commodities themselves? It takes various things in order to produce commodities and engage in commodity businesses. And often, really hot stocks are those that are providing that infrastructure. For instance, equipment to operate mines and wells, drills, drill rigs, tunneling equipment. Companies that make all that stuff immediately go up when the commodities go up. Farm supplies, companies that provide things like seed, fertilizer, herbicide, insecticide, farm equipment and machinery. Those have all been going blazes recently. As the food becomes more valuable, the machinery to produce the food also becomes more valuable. Technologies to locate commodity deposits. Let's say in the oil business, there are companies that specialize in locating oil deposits, and they have extremely sophisticated computer technology to do that. And they're always competing with one another to come up with the next generation of technology. A lot of hot investments there. Transport, ships, trains, pipelines for gas, for oil, become hugely important. In fact, a major investment category is tanker companies that ship oil. And if you look at the prices, as oil goes up, inevitably those tanker companies go up in price along with it. So you can put money there. I mentioned MLPs, that stands for Master Limited Partnership. This is basically for pipeline companies that send either gas or oil through pipelines. And the advantage to holding those is that your dividends, and they're typically fairly high dividend payers, are actually exempt from tax until such time as you sell the stock. The government regards that as a return of capital as opposed to a dividend. So for those that are interested in long-term investments, you can do very well with MLPs. Storage facilities, tanks and silos for food, for oil, for gas, etc. Those companies do very well. And even, and this is something that people tend not to think about, the trading facilities for commodities, commodities exchanges, information services for the commodity business have been doing very well. The mercantile exchanges issue stock, and some of those mercantile exchanges have been among the blazing performers for the last year or more. I did, however, want to add one page about risks of commodity trading, not to leave you with the impression it was just easy money lying on the floor. If there is an economic slowdown, if there is a global recession, that slowdown is going to tend to cut the demand for commodities. And in fact, you will see the commodity prices are strongly affected by perceptions of the likelihood of recession. If people think, for instance, there's going to be a strong recession in the United States, that means they'll be buying less products from overseas, and that's going to negatively affect the foreign economies as well. So if that happens, there might be downward pressure on commodity prices. Other thing you need to be aware of is that speculative hedge fund traders have become, over the last couple of years, big players in the commodity market, which they never were before. Now, you've got to consider that at some point, the hedge fund players might be pulling their money out and taking profits. If that ever happens en masse, it could really, be a pin in the balloon. So the commodity prices can be very volatile. Nonetheless, the fundamental trend delivered by price and demand and delivered by the weakening dollar is for commodities to go up.
To find out more about the New York Investing Meetup and to see the notes referred to in the video, please go to our website.